They said the crash was caused by bad loans, by market cycles, by unlucky timing. But those simple explanations hide the truth that the 2008 financial collapse was not an accident. It was the delayed explosion of a hidden decision made quietly years earlier, a decision that rewired global banking, encouraged reckless lending, and planted a financial time bomb inside the world economy. And before we go any further, subscribe and visit the channel for the next video, because what you are about to hear may change the way you look at money forever. At the start of the 2000s, the world felt safe. Houses were selling fast. Banks were eager to lend. Credit cards arrived in the mail. Advertisements promised that owning a home was no longer a dream, it was a guarantee. Loans were approved in minutes, and interest rates looked small enough to feel harmless. But inside the financial system, a very different reality was forming. Banks were no longer building wealth slowly. They were chasing speed. They were chasing volume. They were chasing profit, measured in days instead of decades. The old rules that once forced lenders to carefully verify income, job stability, and repayment ability were quietly relaxed. In many cases, borrowers were approved without proof of earnings. Some loans were designed to look cheap at the beginning, but suddenly became expensive later. These risky mortgages were not mistakes. They were products. Because banks were no longer planning to keep these loans on their own books. They were planning to sell them. Thousands of mortgages were bundled together, chopped into financial pieces, and turned into investment products that were sold across the globe. Pension funds, insurance companies, hedge funds, and even governments bought them because they were told they were safe. And the proof of safety came from official-looking ratings that gave these products top scores. But here is the hidden truth. The agencies giving those ratings were paid by the same banks creating the products. The safer a product was rated, the more everyone earned. This created a dangerous incentive to ignore risk, soften warnings, and keep the machine running. Behind all of this stood a quiet but powerful regulatory change. For decades, a protective wall had separated traditional banking, the kind that protects deposits and savings, from higher-risk financial gambling. That wall existed to stop banks from using ordinary people's money to fuel extreme speculation. Then, quietly, that wall was weakened. With one decision, massive banks were allowed to combine everyday savings with aggressive trading, derivatives, and higher-risk financial bets. This meant your deposits were no longer just sitting safely. They were now part of a global casino. The fuse had been lit. As long as home prices kept rising, the system looked perfect. Missed payments could be delayed. New loans could cover old ones. Everything felt stable. Until it wasn't. When home prices stopped rising, the illusion cracked. Borrowers began missing payments. Then thousands did. Then hundreds of thousands. And suddenly the safe investments were revealed to be built on fragile foundations. Once mortgage payments stopped, the value of the investment products collapsed. And because banks around the world were holding these products, nobody knew which institution would fall first. Trust disappeared. Banks stopped lending to each other. Businesses lost access to credit. Companies froze expansion. Workers lost jobs. Stock markets plunged. Retirement funds shrank. The shock wave moved from neighborhoods to nations. Governments faced a terrifying choice. Allow major banks to collapse and risk destroying the entire financial system, or use public money to save them. They chose to save them. Trillions of dollars were injected into financial institutions. Banks stabilized. But families did not. Millions lost their homes. Savings were wiped out. Entire communities were damaged. And the world entered one of the most painful economic periods in modern history. Years later, new rules were announced, and politicians promised that this would never happen again. But the truth is uncomfortable. The structure of the system remains largely intact. Debt levels are higher. Financial products are more complex, and decisions are still being made behind closed doors. The global economy does not collapse with explosions. It collapses with meetings, with signatures, with quiet decisions no one hears about until it is too late. This is why understanding how money truly works is no longer optional. It is protection. It is survival. Because the most dangerous financial decisions are not the ones you see on the news. They are the ones being made before the news even knows they exist. So the real question is not how the 2008 crisis started. The real question is what hidden decision is being made right now, and whether we will recognize it before it's too late. Visit the channel for the next video, because the next decision may already be happening.